Hey everyone, happy Halloween. So for those of you who've been watching my videos for a while, many may remember my take on yield curve inversions last July. At that time, the yield on the 2-year Treasury had just pushed above the 10-year Treasury, and I suggested that the resulting yield curve inversion was not a bulletproof indicator of an impending recession. Instead, I pointed out that the more accurate yield curve measure for predicting recessions was the 3-month Treasury versus the 10-year. In the last 57 years, the 3-month Treasury and 10-year Treasury yields have inverted 10 times. Of those, a recession followed the inversion within 16 months, 8 times. Last July, the 10-year Treasury rate was comfortably 56 basis points higher than the 3-month rate. But last week on Tuesday, the 3-month Treasury closed at 4.14% and the 10-year closed at 4.10%. Yes, the 3-month, 10-year Treasury yield curve has inverted. Does that mean a recession is coming? As always, the answer is maybe. To give you some perspective, here are some insights from the October Wall Street Journal Economic Forecasting Survey. It includes forecasts from over 50 leading economists. On average, that group of noted economists set the probability of a recession in the next 12 months at 63%. As for severity, the average forecast GDP growth in the first and second quarters of 2023 were negative 0.2% and negative 0.1% respectively. That's barely below zero. Out of the 63 economists' forecasts, the most negative for the first quarter was negative 3.9%, and the weakest outlook for the second quarter by a different economist was negative 2.5%. So, combining these two forecasts for a worst-case scenario gives us a quarter at negative 3.9% and a quarter at negative 2.5%. To put that in perspective, the pandemic recession delivered a negative 29.9% body blow to the economy in the second quarter of 2020. The global financial crisis had 4 contiguous quarters of negative GDP growth, with the worst being negative 8.5% in the fourth quarter of 2008. The recession of 1990 and 91 had a quarter with negative 3% growth and a quarter of negative 1.9%. And the recession of 1981-82 hit negative 4.3% and negative 6.1%. So if we face a recession that combines the worst first quarter forecast by one economist and the worst second quarter forecast offered by a second economist, as surveyed by the Wall Street Journal in October, the next recession could be a little worse than the recession of 1990. That recession is broadly considered to be a mild one, and it was, incidentally, followed by 10 years of growth. If the next recession is anywhere near the average forecast of the 63 leading economists, then it will be the most mild recession ever. But there may be another shoe to drop. A lot will depend on the Federal Reserve. Following their upcoming meeting on November 1st and 2nd, Chairman Powell will have a press conference and he will announce the new overnight rate. That rate announcement and Chairman Powell's commentary could cause a lot of economists to change their forecast, so we'll have to see what he says. But I want to encourage investors to not get too focused on the inverted yield curve or the recession risk that may be out there. If the recession is as mild as most economists think it will be, at least for now, then commercial real estate will be a very well-positioned asset to weather the brief, mild storm. Don't forget, after every recession, there's a recovery cycle and a growth cycle. And when there's growth, commercial real estate tends to do very well. Considering that most investors hold their real estate for 5 years, 7 years, or much longer, the real focus shouldn't be on the next few quarters. investors should be thinking about what the recovery and growth cycles following the next recession will look like. It's all about looking past the short-term choppy quarters and keeping your eyes on the horizon.